So what's quite possibly the most important decision that you will make when starting out as a freelancer? That decision is what type of business entity that you're going to form for your new business. Your entity will determine how you'll organize your business from a tax and liability standpoint. Every entity has its own set of pros and cons that suit different needs and expectations. So whatever entity that you choose should be what works best for your business. There's no one answer. Just a reminder that we are providing general tax information about taxes, and it's important to talk to a tax and legal professional about your specific situation. Realistically, many freelancers don't think very much about choosing an entity. You just start doing business, taking in that side hustle, and a few years later, you end up realizing you never chose your company or how to structure your company. While this is totally normal, it does come with a major drawback. You'll end up with one of the default entities, which is a sole proprietorship if you're working alone, or a partnership if your company has 2 or more owners. These default entities might be perfectly fine for you, but if you settle for them without weighing your other options, you might miss out on some of the perks that come with the alternatives. All right, so let's get started with the sole proprietorship, the most common entity. A sole proprietorship is the default business entity for freelancers. And this means that if you start working as a freelancer without forming an LLC or corporation, you'll automatically operate as a sole proprietor. A sole proprietorship is easy and cheap to form and run, so it's an easy choice when you're first getting up and running. Plus, you can always go back and form an LLC or corporation later, once your business becomes more established and you're earning a little bit more money. As a sole proprietor, you personally own your business and all of its assets outright, as opposed to having the business having ownership rights. You have complete autonomy and don't have to get permission from certain states to do business under a business name. And because you and your business are considered one for tax purposes, you do not pay taxes or file tax returns separately from your business. You just report your income or losses on your personal tax return in the form IRS 1040 and list all of your business income and deductible expenses on Schedule C, profit or loss from business. Adding your business profits to any other income that you report, like interest income or your partner's income, gives you your total income, which is taxed at your personal tax rate. There's no separate business tax rate. And if you incur a loss in your business, you can use that to offset income from other sources. Because the sole proprietor and the business are one and the same, a sole proprietor could be held personally liable for all debts and liabilities of the business. There is no legal protection against any type of legal activity. This is actually the main reason why many freelancers eventually establish another entity for their business, as their business expands for the liability purposes. This does mean that a business creditor, basically anyone that you owe money to, can go after all of your personal and business assets to get what you owe them. This could even include your personal assets like bank accounts, cars, and even your house. And on the flip side, a personal creditor could do the same thing. They could go after any of your business assets. Those could include your business bank account and equipment. There is no legal barrier between any personal or business assets or liabilities. If you like this video and want to see more of our content, hit subscribe right now. We'd really appreciate it. Next up is the partnership. This is the default entity for a business with multiple owners. Like a sole proprietorship, it automatically comes into existence when 2 or more people start a business together. If you're going to run your business with other people, you cannot be a sole proprietor. Instead, there will be co-owners within the company, and those partners will jointly manage the business. In a partnership, the partners contribute money, property, or services and get a share of the profits in return. Unlike a sole proprietorship, the partners do not personally own the assets of their business, and instead, the partnership owns them. A partnership does not typically pay taxes itself. Instead, the business income and losses are passed to the partners and reported on their individual federal tax returns. You'll need to file IRS Schedule E with your return, showing your partnership income and deductions. A partnership is also required to file an annual tax form, Form 1065, U.S. Return of Partnership Income with the IRS. However, this is just an informational return, letting the IRS know about your partnership's income, deductions, profits, losses, and tax credits for the year. Each partner must pay income tax, as well as Social Security and Medicare taxes, also known as the self-employment tax, on their share of the partnership income. And while a partnership is relatively easy to establish, the partnership does not provide limited liability to its partners. Just like a sole proprietorship, the partners are personally liable for all of the partnership's debts and lawsuits. As a partner, you are also personally liable for business debts that your partners incurred, even if they had nothing to do with the business itself. For this reason, partnerships are not very popular. A limited liability company, also known as an LLC, is a hybrid between a sole proprietorship or partnership and a corporation. LLCs have become increasingly popular because they combine the informality, flexibility, and tax characteristics of a sole proprietorship or partnership with the limited liability of a corporation. With an LLC, your business has its own legal existence that's separate from you, the person. The LLC is technically considered its own legal person and provides its owners with limited liability, which means generally you will not be personally liable for any debts incurred by your business, like you would with a sole proprietorship or partnership. Hence the name, limited liability company. Forming an LLC is relatively easy and does not require a ton of paperwork like forming a corporation might require. Now, it does require a little bit more than the partnership, right? When we set up our LLC, it took my wife and I all 5 minutes to set up the LLC. The limited liability can also prevent business creditors from going after your personal assets, and on the flip side, prevents personal creditors from going after business assets. They are legally separate entities, and that's a good thing. Usually, a single member LLC is taxed the same way as a sole proprietorship. You report profits, losses, and deductions on your Schedule C. If that's the case, the LLC is referred to as a disregarded entity by the IRS. And if your LLC has 2 or more members, it's usually treated like a partnership for tax purposes. Your multi-member LLC will prepare and file the same tax form used by a partnership, which is that IRS Form 1065. Now moving on to corporations. A C corporation is the most complex type of business entity to form and run. It's also the most expensive. Because the LLC and sole proprietorship models are much more common for freelancers, I won't get into the traditional corporation too much. Just keep this in mind. You can get many of the same benefits that you get from forming a corporation by forming an LLC. C Corps pay income taxes on their net income and file their own tax returns with the IRS. They also pay federal income tax at a flat 21% rate, which is lower than individual rates at some income levels. While a C Corp might be a better choice for businesses that bring in substantial profits, it isn't such a good option if you expect to lose money in the first few years. It's because you cannot deduct these losses from any other income that you earn, like your salary. An S Corp is the most popular type of corporation for one-person businesses because it can reduce the amount of Social Security and Medicare taxes that you pay. And unlike a C Corp, an S Corp is not a separate tax-paying entity. As an S Corp, corporate income or losses are passed through directly to the shareholders. That means you and anyone else who owns your business. Normally, an S Corp does not pay any taxes, but it must file an information return with the IRS. This reports how much the business earned or lost, as well as each shareholder's portion of the corporate income or loss. When you decide upon your entity, you should also establish a tax ID number for your business. This is referred to as an employer identification number. You can do this in just a few minutes by visiting irs.gov and submitting your application online. It's a relatively simple process, and your tax ID number is typically given instantly. Thanks so much for watching. I'm Tony from Wealthfront. Take care.